This is Right on the Money with Tom Mosley, founder of Mosley Wealth Management.
Our mission at Mosley Wealth Management is to help people make sure they never run out of income the rest of their life and they pay as little as they're legally required to pay in taxes.
Since 1995, Tom Mosley and his team have been creating comprehensive, custom financial plans to help you preserve what you've earned and pursue what you've envisioned.
In retirement, a lot of people have built a great lump sum. We call that your lumber yard. But you need a blueprint to put that lumber yard into a plan that you can build a retirement house to live in.
What's on your mind this week, Southern California? The stock market, taxes, inflation, income, Social Security, how to ease into the life of your dreams? Let's discover conservative financial strategies starting right now. This is your Right on the Money Radio Hour with Tom Mosley.
And a very happy weekend to you. This is Right on the Money with Tom Mosley. He is the CEO and president of Mosley Wealth Management, and I'm your host, Kristin Oakley. Tom, my friend, a very happy Thanksgiving weekend to you. I hope you had a great time in Nashville. Are you still digesting all that delicious food?
I am a much larger investment advisor than I was last week. So it has nothing to do with the amount of money that we manage. It has everything to do with the turkey that we ate.
Oh, man. I think a lot of people listening can relate to that right now for sure.
Right.
Oh, well, I'm excited to be back with you this weekend. We have such an important subject. It's going to be a jam-packed show. The title, if we had to give today's show a title, would be To Contribute or Not to Contribute, the Problem with Qualified Plans. And Tom, you and I have talked before about this article that recently came out in Investment News. And the title of the article said, Stop Contributing to Your IRAs and 401ks. And the first sentence of the article actually said, Stop contributing to your IRAs and 401ks? That must be a typo. But it went on to explain why this decades-old strategy of retirement planning is no longer working for a lot of folks. And so we're going to unpack that today and talk about this article as kind of the inspiration for the show, because there's so much to get into as it relates to this important subject. So my first question for you, can you explain why someone, such as in this article, might suggest that a person stop building their IRAs, their 401ks, and their other retirement plans that are these qualified plans?
Well, that's a great question. A qualified plan, just in case you're sitting out there and you say, what's a qualified plan? A qualified plan goes to the core of why someone might suggest that people stop putting money into those. A qualified plan means you pay no tax right now when you put the money in. In other words, it actually, if you make $120,000 and you put $20,000 into your 401k, and you can't put that much money into an IRA, but a 401k, a 403b, you put $20,000 into a 401k, you're only going to pay tax this year on $100,000 because the $20,000 that went into the 401k or the 403b or the $6,500 or $7,500 that goes into an IRA, you get to deduct that and not pay tax on it this year. So a lot of people we've been told for years, go ahead and put your money into a 401k and you lower your taxes for now. And here's the other thing, it grows without tax as it grows. But the real gotcha, and this is one of the things that people are beginning to look at, the real gotcha is you are taxed fully, not as capital gains, which is the growth and the value of what you've invested in, but you are taxed fully at regular income when it comes out.
At ordinary income rates, right?
At ordinary regular income. So if you're at like right on the cusp of going over into a higher tax bracket, for instance, if you're single and you're at $45,000, you're up to 12% tax bracket, right up to $45,000, right in that ballpark, and then boom, you put another $10,000 income in there, then you're paying 22% tax on that. Whereas if you put that $10,000 into a 401k or a 403b, you're still in the 12% tax bracket. So it does have a way of saving tax now. So that's one of the reasons that people are saying, that's one of the values of a 401k. And by the way, Kristin, I usually say when I do on my YouTube channel and when I'm doing a YouTube or when I'm doing a podcast, and you can go to our website, Mosley Wealth Management, and I think we've got almost 100 podcasts out there just teaching on different subjects. I always say this is not specific tax, legal, investment, or gardening advice. Okay.
Right.
So it's none of those things for you to take and run with it. I'm just telling you in general, some people understand, you need to understand there are benefits and there are drawbacks to every single plan that's out there. Man so far has never created, nor woman has created, a perfect retirement plan or a perfect vehicle. There are positive things and there are negative things. And before you take any advice we give you and run to the bank with it, you need to make sure that it's specific advice that is pertinent to you, that fits your situation. But some people say, don't defer the tax now, is what they're coming across with.
For your own no-cost retirement blueprint, call Tom Mosley of Mosley Wealth Management, 888-930-5609. That's 888-930-5609.
And so just to clarify, because I think a lot of terms, I know this used to trip me up before I got into this industry and trying to understand. A tax-deferred plan is the same thing as a qualified plan. So the way I like to think of it, if it's a qualified plan, that means you are qualified to pay taxes on that money. And I think that is helpful to understand we're talking about the same thing when we're talking about a qualified plan and a tax-deferred plan. You don't have to pay the tax on it now, but that means you're going to have to pay the tax on it later. Now, here's what this article pointed out that I think is really important to presence for folks. Back when these types of tax-deferred and qualified accounts were created back in the early 80s, it was sold to us as this is a good thing for you because you get a tax break today, and then in retirement, when you take the money out, supposedly you would be in a lower tax bracket. So why is that no longer the case? Why is that no longer a good thing for folks?
Because people are realistic. people are honest. When you get to retirement, let me ask you a question. If you're out there and you're listening to us, and I hope you are, and I hope you maybe tell somebody else about the program and be on it every week because we're here every single week. But if you're out there listening to us and you're saying, yeah, when I get to retirement, I'm going to spend less money. I have one question for you. How has that worked for you in the past? Generally people aren't able to just constrict their budget. In fact, studies show that in the first 10 years of retirement, and I've seen, there's so many studies on retirement, Kristin, that you can almost find one to say anything you want. But generally, people spend between 85 and 90% in retirement what they spend in their regular life. It only planes down a little. And we've talked before on the show about, you're not going to be traveling to El Segundo every day, or you're not going to be driving on the California freeways every day. No, but you're going to be traveling to Venice, Italy, and different places.
All those bucket list items, right?
Yeah, you've got to build those into what you're spending, and they're going to cost money, and the money generally is not going to come from something that's already been taxed. You're going to take the money out of these qualified plans that are still to be taxed. So what people are finding is it's only really a short-term savings. I've got to pay tax on it later. And your tax burden, here's one word to think about. In a 401k or in an IRA or a 403b or any of these qualified plans, these retirement plans, that money as you take it out is taxed forever. As long as there's money in there, you're going to pay tax. Now, I ask this question in every one of my seminars. I ask, do you think taxes are going to be higher in the future or lower in the future? You need to call in right now if you think they're going to be lower in the future, because you're the only person in America, and I want to meet you. Because with the debt we have and the payment we have just on the interest on the debt, almost everyone thinks they're going to be higher. And we know that in 2026, the rates are going back up to the tax before we had the tax cuts in 2017, 2018, the rates are going back up to those old retirement margin bracket rates. So the 10's going back to the 12. The 12 is going back to a 15% rate. So we are going to have a tax increase. So you ask the question, won't my income tax be lower in retirement? It's a common question, but for most people, it's a myth because you still are going to spend the same amount and you're going to have what some people call bracket creeping because you know, what does inflation do to what you need as well?
Right.
You know, you say we need 45,000 as a single person right now, or you multiply that by 2, you need 90,000 a year as a married couple, but that's going to creep higher and higher. Yeah, the brackets go up a little bit, but generally inflation goes up more.
Right. And the cost of living doubles that much faster for you.
It absolutely does. So you ask, why is it so frustrating? Weren't we told? Yes. But the reality of living this thing out, it just ain't what it was supposed to be. And so people are beginning to find that out and they're beginning to say, should I put money in a qualified plan? Now let's talk about the good of the qualified plan. I always like to say this. The nice thing about a qualified plan, if you're 20, 30, 40, in your 50s even, it's automatic. It's automated. It comes out. You don't have to write a check for it to put it back in somewhere. So there's some benefit of saving that way, and there's some benefit of putting it away. But just understand that money is forever going to be taxed at regular income tax rates when it does come out in retirement. You know, Kristin, there are so many what I consider, you know, just really tough things about the tax law, and as it impacts regular income, as it impacts retirement plans, as it impacts your Medicare when you're in retirement, as it impacts capital gains and the way it's taxed in a different way. And one of the things that we do when somebody comes in for a retirement blueprint, they raise their hand from the show, they call in, they get on our schedule of one of our 6 advisors. They're all fiduciaries, and they get on our schedule, 5 offices, Glendale, Arcadia, Ontario, main office in Anaheim, office down in Scripps Ranch in San Diego. They bring their stuff in, and we give them an evaluation, and we put together reports on your situation. And one of those reports is a tax report to show you what kind of potential tax burden you have in your 401k. Do you want that? Then call in, get on our schedule. We'd love to see you.
Tom, thank you. That number to call to get your very own tax report, 888-930-5609. So much more to cover on today's show. To contribute or not to contribute, stay with us. We'll be back right after this.
When making important decisions in your life, how many opinions do you seek out? You might ask your spouse, perhaps family and friends, or an expert or professional in that field. Most importantly, you may seek someone who has experience with the decision you're making. A friend of mine once said, you can't get a second opinion from the person who gave you the first one. Call Right on the Money and the team here at Mosley Wealth Management for your complimentary second opinion about your retirement plan. 888-930-5609. That's 888-930-5609.
Welcome back to Right on the Money with Tom Mosley. I'm your host, Kristin Oakley, and Tom and I are having a lively discussion today centered around this conversation of to contribute or not to contribute, the problem with qualified plans. And, you know, Tom, in the first segment, we talked about this article that recently came out that even proposed that people should stop contributing to these qualified plans, these tax-deferred plans, such as 401ks, traditional IRAs, things of that nature. But the reality is the bulk of Americans have the majority of their retirement savings already in these types of qualified plans, whatever workplace retirement plan. It could be a 403B, a 457, you know, all these plans that are tax deferred. So it begs the question, what should someone be doing with these types of plans? What should someone be doing with their own 401k, for example?
You know, I'm a statistic reader like crazy, and I don't always remember every single article, but I remember specifics about those articles. And the last one I read, there's 85% of all retirement money is sitting in these plans. So it's still to be taxed. And with a government that is $33 trillion in debt, they're sitting there looking at these qualified plans, sort of like Pavlov's dog. They're salivating.
They can't wait to get their hands on it, right?
They're ready to feast on it. So what can you do? All your money is sitting there, and what do you do with the 401k? And some of you are working and you're under 59 and a half, and usually that current 401k where you're working right now, you can't do much with it before 59 and a half. But some of you have worked other places, and you've got a 401k that's dormant. 401k is what we call it, and it's sitting there in one of the big box firms or with the firm that held the assets through the other company. And sometimes people come to our retirement master class, or they come to our tax class or our Social Security class, and they go through an inventory, Kristin, and they find out, oh yeah, I remember I've got an old 401k, So what do you do with those old 401ks and some of those things? Well, if you have a dormant 401k and you're under 59 and a half, you can move that over into an IRA. Why would you want to do that? You would probably want to do that because with the IRA, you'd know more visibly, more transparently what you're really paying in fees, because there are fees within 401ks, and a lot of them are hidden, and a lot of them are higher than most people think.
Right. So no one's managing that for free. Newsflash, right?
It's key. I'm glad you used the word managing it. Nobody's managing that 401k. It's usually just sitting there. And there's not anybody watching it. There's not any professional money manager watching it. And you say, well, I don't want to pay a professional money manager. Well, look at some of the surveys. Survey after survey after survey says if you work with a professional money manager, you're going to make more than if you do it yourself, just simply because of the mistakes that you make. I read in a class I take through the American College out of Pennsylvania, that's a financial training school and for financial advisors, and it showed that people could actually make 37% more by just the little small mistakes they make on 8 or 9 different decisions they make in their lifetime. So one of the things you can do with that dormant 401k is you could roll it over into an IRA, and you could get more boom for your bucks, more variety. You could have more options. You could actually, we talk about the retirement blueprint and building a plan, a written plan. You could actually 10, 15 years before retirement, and we're getting a lot of you who are calling in this way. You call in and we begin to put together that retirement blueprint way before it's time to retire. I mean, a football coach doesn't walk on the field and start taking a pen out and writing out his game plan. That football coach has been working on that game plan at least a week before. And usually if they're really good, they're looking down the line 2 or 3 weeks to the opponents that are coming down the line, and they're making a game plan. And by the time the game starts, the time to put the plan together is over. I mean, you can revise it, and you can change it, and you can adapt it, and you need to do that. But the game plan needs to be started with retirement early. And that's what we call the retirement blueprint. So one of the things you can do is take those dormant 401ks, move them into an IRA, and start building your game plan. Now, if you're still working and you get laid off and you're 55, there are ways to access the money that's in your 401k. I recently had a gentleman out in Chino, and he retired at 57, and he had all of his money in his 401k, and I think it was around $800,000 or $900,000 was in his 401k. And he was like beside himself because taking money out of a 401k or an IRA before 59 and a half incurs a 10% penalty normally.
Yes.
Okay.
Right.
So what we did was we said, how much money are you going to need in the next 2.5 years until you get to 59 and a half? And so we made some assessments. We padded it a little bit to give him some margin, and we left that money in the 401k because if you're 55, there's a provision that allows you to take income out of the 401k. And so there's some ways to do it. Now, what would have happened if he was like another guy who came in at almost the same time, Kristin, and this guy had almost the same amount, and he walked into my office and he said, I retired at 56 and I have $1.2 million. I had it in my 401k, but I just moved it over to an IRA, and now I want you to help me. So I sat down with this gentleman, and guess what? He needed income from it too. But because he had moved it out of the 401k into the IRA, he did not have that option.
He couldn't touch it until he was 59 and a half.
Well, he
right?
could, but what's the problem with touching it?
Yeah, you get that 10% penalty. Yeah.
You got it. Exactly right. And so he literally, we worked with him still, but he had made a colossal mistake because by the time he got to be about 58, we then began to have to pull money out of the actual IRA he had started, and there was a 10% penalty until he's 59 and a half. Kristin, that illustrates just one of the things where you can get yourself in trouble if you do the do-it-yourself route. So why would you want to move to the IRA? Well, you know, we're required by law to tell anybody that's moving a 401k, you can leave it there. A lot of people have.
Right.
You can move it to a new 401k if you're still working. You can cash it out and pay the tax on it, which is usually not a great idea.
No, not recommended typically, right?
No, but it's one of the things that the government requires us to tell you because some people might take that option if they're reading it just for themselves.
Sure.
Or you can roll it over into an IRA. Okay.
Yeah.
So here's another reason you might want to consider moving out of a 401k. A 401k is, if you were to classify most of the investments within a 401k, you would classify them as growth or aggressive.
Yes.
And they're built really for like 20-year-olds, 30-year-olds, 40-year-olds.
Who have that long time horizon ahead of them.
The market's going to go up and the market's going to go down. And they have the opportunity to wait it out.
Right.
Now, in the first segment, we said, you know, some people are saying don't contribute to a 401k. I do have some of my younger clients who've come to me in their 20s and 30s, and they've actually called me and said, the market is so fluctuating. It's actually from 2 years ago till now, every one of the major indices is down between 2 and 10% in the past 2 years. So a lot of people are saying, the market is down. Should I quit contributing to my 401k? No way. That's the time to contribute. So I just
everything's on sale. We've said that before, right?
Everything is on sale. That's the time to buy. You know, nobody gets an advertisement that says all of the prices. I'll use Sears because there aren't any Sears anymore. But you know, all the prices at our store, we've moved them up 15%. Please come this weekend. Nobody's going to go to that. But when they're down 15%, or down 10%, that's a great buying opportunity. But the 401k is by nature an aggressive portfolio, a growth portfolio. So what a lot of people see the reason for moving out of the 401k into an IRA is they're not willing or wanting or feeling or tolerant to such a high risk level anymore.
Yes, because if you leave that money behind in a very aggressive account, let's say, what if 2008 happens again? I mean, this is why so many people were financially devastated, because that money was sitting in those more risky investments in these types of plans, hadn't been accounted for or adjusted based on the fact that they were entering or nearing retirement. And now they were hit so hard at the worst possible time, right when they were trying to retire.
Get your retirement right on the money with Tom Mosley. Call 888-930-5609 for your no-cost appointment. 888-930-5609.
You couldn't be more appropriate, Kristin. What if you're going to retire next year and you have $1 million and we go through a 54% downturn like we did around 2008, or a 47% downturn like we did from 2000 to 2002. Those are within the last 25 years.
Right.
What if we had another one and you've gotten your amount up to $1 million? If we had a 50% downturn, that means that if you retired next year after experiencing a 50% downturn, you are now sitting with $500,000. You want me to tell you something?
What's that?
You're going to continue to work
Yeah.
You're going to continue to be there. You're going to continue to build it back, grow it back, allow the market to grow it back. And that's one reason that you can find more safety in other alternatives.
Mm-hmm.
The risk score. That is so important. As part of our retirement blueprint, we talk about that as the whole. But one of the rooms, you might call it, of that retirement house that we build for people is your risk tolerance.
Mm-hmm.
How much are you willing to tolerate in a downturn? One of the key reports we run on everyone who comes in is we take your portfolio, and people are shocked. Take your portfolio, run it through a scenario that if we had a downturn like we had in 2008, how much money would you lose? This week, Kristin, I've seen 37% drawdown, 42% drawdown, and a 51% drawdown because people were so aggressive.
Wow.
You need to know your risk score. And we're willing to show you that and then also show you the risk your portfolio's taken. But you have to call in and get on our schedule. Kristin, you want to tell them how to do that?
Absolutely. In order to get your very own personal risk score as part of your complimentary retirement blueprint, all you need to do is call 888-930-5609. Again, that's 888-930-5609. More on Right on the Money with Tom Mosley right after this.
Is having $1 million enough to retire? For years, many have considered this to be the goal amount to have for retirement savings, $1 million. But that's the $1 million question. Is that enough for today's modern retiree? Are you sure you've saved enough for a 25 or 30-year retirement? Are you concerned about covering large expenses, including taxes and long-term care? If so, you're not alone. But there is a solution. With a comprehensive financial plan, you can take control of your finances to help you achieve your long-term goals. At Mosley Wealth Management, let us help you work towards peace of mind by implementing a complete retirement strategy. Call Tom Mosley and the team of Mosley Wealth Management right away to receive your complimentary, comprehensive written financial plan. 888-930-5609. That's 888-930-5609.
Are you worried that you waited too late to start your retirement planning? That you waited too late to start saving? At Mosley Wealth Management, we believe it's never too late to start planning for your future. We can help you develop a personalized retirement plan that is tailored to your current needs and goals. The team at Mosley Wealth Management will sit down with you and provide an evaluation of your current path, including your investment strategy, tax planning, and risk management approach. We'll help you identify potential areas for improvement and work with you to create a retirement plan that is designed to help you work towards having financial security and peace of mind in retirement. It's not too late for you to get started with Mosley Wealth Management. Call us today to schedule your complimentary retirement planning session. We believe we can help you get on the path to financial security and peace of mind in retirement. Call Tom Mosley and the team at Mosley Wealth Management to get started on your own complimentary retirement blueprint. Call 888-930-5609. That's 888-930-5609. Welcome back to Right on the Money with Tom Mosley. He is the CEO and president of Mosley Wealth Management, and I'm your host, Kristin Oakley. I know we've been talking today about this problem that qualified plans, these tax-deferred accounts that most Americans have the majority of their wealth accumulated in. So we've set up in the first half of the show kind of the situation, what it is folks are facing, navigating this challenge. Let's talk about some solutions, shall we? We like to be positive on this show and offer real world solutions to this problem. So, Tom, what have you got for us when it comes to how we navigate this challenge?
Well, one potential solution, and I think it's the major potential solution, is to move to a Roth, ROTH, with the money that you're contributing to an IRA, or if you have the opportunity to move to a Roth investment within your 401k. Now, Congress has passed the Secure Act 2.0. After leaving us very insecure with the Secure Act 1.0 and having to change it 4 or 5 times, they've come out now with a Secure Act 2.0. And one of the things that they're doing, Ed Slott, who's known as America's authority on IRAs and 401ks, Ed Slott has come out and called the Secure Act 2.0 the Rothification of retirement planning. And what they've done is they've they tried to mandate it by the first of this coming year, 2024, but they put it off a couple of years, where most 401ks of any size company, they're going to be required to offer a Roth 401k. Now, what's a Roth? What's the difference? Well, with a Roth 401k, you do not get the tax deduction for money that goes into there. We said earlier, if you're made $100,000 and you put 20 into a regular 401k, you only pay, if you make 120,000 rather, and you put 20,000 into the 401k, you only pay tax on 100,000. If you're making 120,000 and you put $20,000 into the Roth, swallow really hard here, you're going to go ahead and pay the tax on the money that goes into it now. Yes, you're going to be taxed now at the rates we have now. You're going to pay the taxes, but here's the nice thing. You're going to pay the taxes now, but you're never going to pay the tax again. Remember, I introduced the word in a previous session this morning, the segment this morning, about forever, as long as it's in the 401k or the IRA. Well, in the Roth, you never get taxed on that. It once you pay the tax and it goes in there. It grows without tax. It comes out without tax. You get a 1099 on it just because they're tracing it, but there's nothing in the box that shows income because it does not add to your income. You say, what's the benefit of that? Oh, do you have all day? The benefit of that is you do not have to take required minimum distributions, a certain amount that sometimes is confusing at age 73. You do not have to take required minimum distributions. That's a beautiful thing.
It is.
Because you can leave it in there as long as you want or forever, as long as you want in your lifetime.
And if you pass it on to your heirs, then they don't have to pay that either.
Wow, we like that as heirs, don't we,
right?
Kristin? I mean, right, because but the biggest catch is between our passing away, if we're married, and the leaving it to our heirs is when we leave it to a surviving spouse.
Yes.
Because all of the money that comes out of the IRA comes out as regular income, so it's taxed according to your marginal tax bracket. But when you have only one of the spouses that are left and you go from married filing jointly, you go to a single tax status the year after when you file your income tax, your brackets are basically cut in half. So taking almost the same amount of money out is going to push that surviving spouse. They call it the widow's penalty because it just pushes that tax bracket you into a higher and a higher and a higher tax bracket. What we strive to do with the people we're working with, particularly if they're married, if you're single, we do everything we can to get it into a Roth by converting it over into a Roth. If you're married, we try to get that done by the time one of the two pass away so that the surviving spouse has no tax to pay on that because it's in a Roth. It's never taxed versus forever taxed. It's so important that you understand how crucial that is. And then, Kristin, you're right. Then it goes to the heirs. And if you pass along a pretty healthy amount of money to your heirs and they're successful, and it's still to be taxed, you could put them in a pretty severe tax
situation
burden.
themselves. Yeah.
It could really be a burden to them. And some people say, well, it's free money to them. They haven't really done anything. But then some people come along and say, I don't want my kids to have a tax burden.
Right.
So I am a huge fan of Roth conversions, where what you do is you begin to take the money out of those qualified plans now, Kristin, I've not had anything to drink and I'm not inebriated, but you pay a little bit more tax now, staying within your tax bracket, and you pay that tax and you begin to do what we call tax harvesting, moving that money from the IRAs over into a 401k.
Right. So from these tax deferred, from these qualified plans, moving it into a Roth account.
a Roth account from forever taxed to never account. I misspoke and said 401k. I did not mean that. I meant moving it into a Roth. So what you do is, now let me give you, for instance, if you're single and you're making $60,000 a year, you're right in the middle of the 12% tax, or the 22% tax bracket, excuse me. If you're making $62,000 and you're single, multiply that by 2 if you're married, you're at $120,000. You're right in the middle of the 22% tax bracket. If you're single making 60, you've got about another $30,000 and you're still going to be in that same tax bracket. If you're married, you've got 60. So why not consider, and we've got software that can show you all the ramifications of this, why not consider converting another 30 if you're single or 60 if you're married, paying the same rate you're always going to pay at that marginal tax rate. Don't push yourself into a higher bracket, but pay the tax on it now and harvest that out into a Roth.
With the known tax rates of today versus waiting on the unknown, which probably are going to be higher later.
For 2 reasons. We know they're going to be higher in 2026, and we probably can assume they're going to be higher overall because of the tax of the debt burden that the United States is carrying. So it's very time sensitive that somebody you still have time to do it. You still have a month to start working with somebody to do this so that you make sure and do it right in 2023. You have 2024 and 2025 where these rates are going to be lower. They're on sale, like you said earlier. Why not take advantage of the sale and then begin to work to move that money from the forever taxed 401k, 403b regular IRA into the Roth IRAs, and you're never taxed again. You say that sounds a little confusing. It absolutely is sometimes. It absolutely can save you a ton of money. There was a guy this week that had $500,000, and we are beginning to work with him. If he pays it, people say, I don't really have a tax plan.
Right.
Guess what, Kristin?
You have one whether you realize it or not.
They've got a tax plan where they realize it or not. This person is going to take that $500,000 where they, according to the government's tax plan, would pay out $284,000 in tax if they live until 90 years of age or their spouse does, whereas we're going to move them over and pay tax on $110,000 legally. Legally.
Right.
The illegal way of doing tax, there's a name for that plan. It's called the penitentiary.
Right.
Okay?
And that's not what we advocate on this show at all.
Not at all. We don't advocate, number one, your income plan being which child will you move in with, and your tax plan, go to the penitentiary. What we will run for you, if you call in, it's what we mentioned the last segment. We will run a tax report to show you how tax harvesting, the amount of dollars that you potentially could save by doing that. If you call in, get on our schedule, and we do a complete retirement blueprint, but just one aspect of that is this tax report. But you've got to call in to get it.
Absolutely. And that number to call is 888-930-5609. Could a Roth conversion be right for you? We encourage you, meet with the team of Mosley Wealth Management. They would love to walk you through, look at your individual situation, and help devise a tax plan that is in fact in your best interest. 888-930-5609. More right after this.
Tom Mosley and the team have helped thousands of folks like you in Southern California plan for their retirement. Now make the call yourself. 888-930-5609. That's 888-930-5609. You've heard the phrase, you don't know what you don't know, and we believe it's especially true when it comes to retirement planning. There's a lot of information out there, and it can be overwhelming and confusing. So how do you know what you don't know? Are you aware of all of the tax implications of your investments? Do you know how to optimize your Social Security benefits? What about your long-term care and estate planning needs? We believe that by working with a retirement planning advisor, you can uncover potential blind spots in your financial plan and gain a better understanding of your options. Don't let unknown factors potentially derail your retirement. Call 888-930-5609. That's 888-930-5609.
Welcome back to Right on the Money with Tom Mosley, CEO and President of Mosley Wealth Management, and I'm your host, Kristin Oakley. And Tom, before the break, we talked about Roth conversions. I know that you are a huge fan. This is something that you do for folks day in and day out to help them eliminate that tax burden in retirement and to do it legally, of course. But we like to talk about the pros and cons and look at the both sides of a situation on this show. And so my next question for you is, when would it make sense for someone not to do a Roth conversion? Because I think it's equally important to understand when it doesn't make sense and when that might not be the best strategy for someone to employ.
Right. When you're converting. Now, let me draw a line between contributing and converting, so I make sure that everyone is clear, because Kristin, when people come in, that's one of the confusing things they have. And in January, February, March, and April, we teach a 1-hour tax class in addition to our Social Security class. And one of the biggest confusions they have is the difference between converting and contributing. Okay. And some people come in and they say, well, I'm already retired. I cannot have a Roth IRA. Kristin, I've started Roth IRAs for people who are 83 years old who retired over 20 years, who've been retired over 20 years. You can start one at any time.
Right.
To contribute to a Roth, you have to have earned income. And if you have earned income up to $7,500, if you're over 50, or if you're under 50, up to $6,500, you can contribute that amount to a Roth IRA. Now, if you're in a 401k, you can contribute to that. But that is contributing. You have to have earned income to contribute. But for those of you who say, well, I got to pass on this show because I'm not earning any income, I can't convert. Anyone can convert. Anyone at all can convert. The government actually likes it when you convert because you're going to be paying more taxes that year, and they need more taxes. Okay,
it's their money.
They might even start sending you thank you notes. I don't know, and that's what Ed Slott had said when he talked about the Rothification. He says the government is leaning now toward getting more people to pay more tax and making it more available for them to pay more tax now. And they're really cutting their nose off at the end down the road because they're going to have less tax later, but they need more tax money now.
Right.
So let's go back to your question of conversion. And anybody can convert an IRA to a Roth, or you can convert at certain times your 401k. Now, after 59 and a half, you have what we talked about last week on the show, the opportunity for an in-service distribution.
Right.
You can convert money over. When would it not be a good idea to do it? Well, I think, let me have a couple of stories and maybe one more illustration. I've got a client that I worked with about 3 months ago. And this gentleman, believe you me, we're like anybody else. We like to work with people. And when it comes to the amount of assets, the more, the merrier. We're not like some people who say, if you've got $500,000, call us, which in essence means if you don't have $500,000, we don't care about you. We care about anyone. I worked this week with a lady who had nothing. She was 50 years old and just getting started. We will help anyone develop a retirement blueprint. But this gentleman had over $10 million. Okay. And he called me because he had heard us talk about Roth conversions on the show earlier. And he said, I want to do Roth conversions. Well, in the process of working with this gentleman, I said, and it's one that we ask every retirement blueprint when we go through the little format of questions so we can know the plan we need to develop for you, which is your individual plan. We said, what kind of family do you have? He said, I don't have any family. He said, I don't have any brothers. I don't have any aunts and uncles. He said, as far as I know, all my mom and dad's parents and relatives, I've never met them. He said, all of my $10 million is going to 501c3 charities. Now, the worst thing in the world I could do for that person would be convert that money from a regular IRA to a Roth. Now, let me tell you why. If this gentleman in his lifetime converts that money into a Roth, he's going to pay federal income tax on it and
Right.
state income tax on it.
Mm-hmm.
And so let's say it's 30% total. If he's got $10 million and we do him this great favor, we couldn't do it all in 1 year or it'd be much more because he'd be in a higher tax bracket.
Right.
But if we converted it over and say he paid 40% of it away in taxes, we would take his $10 million and we would reduce it to $6 million. And yes, it would be in a Roth, but then when he passed away and he left it to his charities, they would only get $6 million.
Right.
Whereas if it's $10 million and he passes away and he leaves $10 million to a tax-free charity, a 501c3, then they get the full $10 million because they don't pay tax.
Right.
So in that situation, I also had another couple this week and they made contact with us and they didn't have $10 million. They had $250,000. And I asked the gentleman, I said, what are you doing with this on a regular basis? And he said, every year, we're doing what's called QCD, Qualified Charitable Deductions or Distributions, and they're taking money out of their IRA. You have to be 70 and a half to do that. They're sending that money directly to the charity, to the 501c3. So
and that
that's
counts
one
for their
reason.
RMD, right? That's why they do it, because it's a win-win for them. They get a tax break for doing it, and it's a win-win for the charity that gets the full amount.
They get the full amount. For instance, if they were to pay the tax on it and then pay what's left to their charity, the charity would get the lower amount, the 60%, like we did in the other illustration. So who's the money ultimately going to? Where's that money going to end up? And you got to figure out, that's one of the key things you've got to decide. The other thing is, if you're 3 years from retirement and you're making $350,000 a year, either as an individual or as a couple, and you say, not everybody's doing that, I'm not doing that. Okay, but if you are, then you're in a really, really high tax bracket. You need to start that retirement blueprint so that you can see what it's going to be like for your budget during retirement. It's probably not going to be a $350,000 budget. It might be. I don't know.
Right.
I don't want to put you in a box. But if you're going to have significantly less income that's going to give you sufficient money for retirement, you may want to wait until you go down in tax brackets to start doing the Roth conversions. And no reason to convert at 39.6. If you can wait a year or two and say retire at 65 and do it at 22%, because you're saving almost half your tax right there. So that's why when we say on this, when we build a retirement blueprint, Kristin, we start with a blank piece of paper. That we don't have any preconceived notions. We've got to take your situation when we decide, do we convert or do we not convert?
Well, and I love that your goal is to help people pay the least amount of tax that they need to pay. It's paying less to the IRS. And that's such a smart thing to look ahead and say, you know what, maybe it doesn't make sense right now, but in a year or two, it could make sense. And so that's an important distinction. Well, you know, Tom, we started off today's show with this whole question of to contribute or not to contribute, which was inspired by that article that Ed Slott wrote in Investment News a few months back. And so I want to pose that question to you because we need to tie a bow around everything we've talked about today. We've covered so much ground. What would you say to answer this question of to contribute or not to contribute as it relates to qualified tax-deferred plans?
Kristin, I've got 5 children, 27, 31, 34, 46, and 47 years old. I tell every one of them, contribute as much as you can, as soon as you can, as best you can. So if you don't have a Roth available to you, it's no reason not to save. So the main thing is save. Now, once you start saving, if somehow, some way a Roth is not available to you, then you definitely need to contribute. I don't think there's very many people out there who can't get into a Roth, either front door or back door. And you can put at least $7,500 a year into a Roth, pay the tax on it now, never pay the tax on it again. Above that, if you don't have a Roth 401k where you can put as much as $30,000 if you're over 50 in a Roth 401k, you need to contribute. Never stop contributing because the market is down, because as we said, you're buying cheaper. Now, this segment right here is just a review of some of the things we've talked about. You need to save, you need to contribute. Market's down, it's a great time to contribute, but put it in a Roth if you possibly can. Take advantage of those automatic matches. We haven't really even talked about that. But here's the main thing. You need to get from more than a CPA. A CPA is a great guy or a great lady, and they prepare your taxes.
They're looking back at last year, right? They're looking at how to save you tax this year based on what happened last year.
They're going to have a wreck in your taxes if you're not careful, because they're always looking in the rearview mirror.
Right.
We look down through the windshield and say, let's develop a plan. Well, I don't really have a plan. You do. The government has it for you. And let's develop a plan to contribute, yes, but where do you contribute that's the most tax efficient way to you? That's where we can help you. And some of you are out there and you're already dreading the first quarter of the year because you know you're going to get slaughtered with taxes. There may be things you can do before December 31st that are monumental in saving you tax. You may need to convert something this year. You can't do that on January 2nd. You need to make sure and call in, get a complimentary review. That means it's free. We don't charge anything for this review. If you decide to work with us after we give you a written plan, we give you a written tax report, that's on you. That's on us if we decide to work together. But we can't help you if you don't call in. You've got to call in for us to be able to help you save money. I love our country. I want us to pay all the tax we are legally required to pay, but not one penny more.
Absolutely. Tom, thank you so much for such an informative and valuable another episode, as they always are each and every week. And to those of you listening, we encourage you, this is a great opportunity to pick up the phone and call 888-930-5609 to get your very own complimentary retirement blueprint. And Tom and the team of Mosley Wealth Management would love to walk you through everything we've covered on today's show. We look forward to being back with you next week. Until then, be safe, be happy, be blessed.
Investment advisory services offered by duly registered individuals through Mosley Wealth Management Incorporated. Mosley Wealth Management and Mosley Insurance and Financial Services are affiliated companies by common ownership license number OB61811. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refers to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength, claims paying ability of the issuing carrier. This content is intended for informational and educational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the needs of an individual situation. All hypothetical examples are provided for illustrative purposes only. They do not represent real-life scenarios. Mosley Insurance and Financial Services, nor its agents or representatives, may give tax or legal advice. Individuals should consult with a qualified professional for guidance before making any investment decisions. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Some of the information provided may be from one or more third parties, which we believe to be reliable sources, but accuracy and completeness cannot be guaranteed by Mosley Insurance and Financial Services.